Okay, so WD-40 officially proved they're not just for squeaky door hinges anymore. Welcome to Earnings Unscripted, folks. It's July 9th, 2026, and we're breaking down Q3 numbers for WD-40, ticker WDFC. And Miro, they literally ran a limited edition Disney partnership this quarter.
Yeah, I definitely didn't have a blue-collar lubricant hype drop on my bingo card this year, but apparently it worked.
It really did. And before we get too deep, just a quick reminder that we're only sharing personal opinions here, so this isn't financial advice. Please don't base your trades on our podcast. But looking at the actual numbers, they're honestly kind of wild. Top line revenue hit about $195 million. That's up roughly 24% year over year. I mean, for a legacy hardware brand, that's serious momentum.
It really is. And the profitability is what caught my eye immediately. Earnings landed at $2.24 a share, which is a massive jump sequentially from last quarter. And the market basically lost its mind in the after-hours tape. The stock drifted down during the regular session, but right when the numbers dropped, the chart just went vertical.
I was watching that. It totally gapped up in the extended session, and I think it settled into something like a 12% surge against the daily close. Wall Street clearly loves a good hardware store display.
Well, specifically that King of the Hill limited can they did with Home Depot and Disney. The CEO mentioned it drove about 75% purely incremental sales, meaning it wasn't just pulling forward their regular demand or cannibalizing the base product. They essentially hacked the consumer merchandise playbook for a purely functional tool.
Which is just brilliant marketing. But I know you're looking past the flashy retail stuff because there's a pretty heavy plot twist hiding in the margins, isn't there? The quarter looked incredibly profitable, but it feels like they're just delaying a lot of incoming pain.
Oh, completely. The gross margins actually expanded this time, but it's a bit of an accounting mirage driven by their inventory cycle. Because they hold about 3 months of product on hand, they're still churning out older, cheaper materials. Meanwhile, the spot costs for specialty chemicals have absolutely skyrocketed due to the friction in the Middle East. It just hasn't hit their income statement yet. Plus, they finally threw in the towel on trying to sell their Americas Homecare business.
Oh, wow, right. And that means they have to totally reshape how they guide the whole company moving forward. All right, there's clearly a lot of structural tension between their pricing power and those incoming supply shocks. Let's get into the details.
Right. Well, let's start with that home care business you just flagged, because that's the real catalyst for basically rewriting their entire corporate playbook this quarter.
I thought the whole point was that they were unloading those cleaning products. Didn't they just divest the UK cleaning segment recently?
They did, but they completely failed to find a buyer for the Americas assets. The macro environment was just too rough, so they had to yank them from held for sale back to held for use, which, by the way, triggered a surprise $1.3 million amortization catch-up expense right now.
Wait, so they're just stuck with a business they actively don't want?
Basically. The CFO literally said on the call, after extensive engagement with potential buyers, it became clear that the current macro environment was not conducive to divesting of these brands as a bundle. As a result, we are no longer actively marketing these brands. They're officially transitioning it into what they call a harvest brand.
Okay, hold on. A harvest brand. Does that just mean they're breaking it up, like selling off individual trademarks one by one instead of a bundle?
No, it's actually much more ruthless than that. Harvesting means they're cutting off the marketing oxygen completely. Zero ad spend, zero promotion. They just sit back and let legacy buyers purchase the products, pulling the cash flow out as sales slowly decline over time.
Wow, just manage decay. You bleed the remaining brand loyalty for cash to fund the stuff you actually care about.
Exactly. It's highly efficient, but here's the catch. Retaining that slow growth segment totally broke their financial models. For years, Wall Street judged this company on a super strict 55% gross margin target.
Right, along with those rigid caps on overhead and strict EBITDA goals.
Spot on. Investors treated that three-part framework like a religion. But because they're absorbing this clunky home care portfolio back into the core, management completely retired that metric today. They sunsetted it.
See, whenever a company retires a beloved metric, it usually just means they know they can't hit it anymore. So what's the new baseline they want us to look at?
They're replacing it with what they're vaguely calling the enduring business model, which really just boils down to a commitment that EBITDA growth will consistently outpace revenue growth.
That's a lot looser.
Much looser. And right as they roll this out, the person holding the financial steering wheel is stepping out of the seat. The CFO, Sarah Heiser, is actually transitioning over to become president of the Americas division.
Oh, from CFO straight into a regional operations presidency. That's an unusual pivot.
Right, which tells you they're probably grooming her for the big job down the line. But the timing's intense. You're losing your finance chief right when you have to start defending margins because, like you mentioned, those specialty chemical spikes are lurking right around the corner.
Right, and if you're promising earnings will outgrow sales, how do you pull that off next quarter with inventory costs finally catching up to you?
You're going to struggle, frankly. Especially because top-line revenue's going to be fighting gravity, too. They admitted that about $3 million of international demand was artificially pulled forward into Q3.
Pulled forward why? Just distributors panicking about geopolitical stuff?
Yeah, distributors were terrified of shipping bottlenecks in the Middle East, plus they knew price increases were coming in Europe and Asia, so they hoarded supply early.
Okay, so Q3 looked absolutely brilliant on paper, but Q4 is suddenly staring down depressed volume and soaring input costs. That's a tough setup. We really should step back and look at what this means for their trajectory over the next year.
Well, they updated their full-year net sales guidance to a range between $675 and $690 million. So they're definitely baking in that retained home care business we talked about last time.
Right, because they couldn't find a buyer for it. But are they actually going to maintain profitability? I mean, you were just saying the cost of specialty chemicals went through the roof.
That's the real stress test. The CEO was pretty aggressive about it on the call. He said, and I'll quote it here, "We will vigorously defend our gross margins and may need to take further action in fiscal year 2027 as required."
Vigorously defend. That sounds almost combative. I mean, further action is really just corporate code for jacking up a price again, isn't it?
Essentially, yes. They already enacted mid to high single-digit price hikes in Europe and Asia. The big question next quarter is whether customers actually accept that. If you're a mechanic and the can suddenly costs significantly more, do you switch to a generic brand?
I don't know. It feels like they have real pricing power, especially since they've convinced people to pay a premium for convenience, like the Smart Straw packaging.
Yeah, that premium strategy acts as a moat right now, and management's projecting confidence despite the headwinds. They updated the full-year earnings guide to a midpoint of roughly $6.20, and the CFO specifically mentioned the fourth quarter will actually be their second strongest of the year.
Okay, so even with the geopolitical storm clouds and that weird demand pull forward, they're not exactly hitting the panic button.
No, they're just, well, completely changing the scoreboard. Remember, they killed that legacy 55-30-25 margin metric today. Going forward, as long as earnings outgrow sales, they'll call it a win.
That's a classic maneuver, right? If you aren't sure you can win the game you've been playing, just change the rules. But to be fair, it's genuinely impressive that they got a blue can into a blockbuster Disney retail display.
It's true. They're squeezing every last drop of value out of that blue can.
Okay, on that horrible pun, I think we're good to wrap this one up. See you after the next call, Miro.
Catch you later.
If you'd like these earnings deep dives to just show up automatically, you might want to follow the feed. As a quick aside, we actually put this show together using AI, and that's exactly how we managed to process those massive transcripts into a chat so fast right after the bell. We'd absolutely love to hear from you, so drop your favorite tickers over to earningsunscripted@datamadness.ca, or just grab the X link in the show notes.